We've seen a pretty clear shift in language from the RBA. A month ago, the warning was about multiple interest rate rises ahead. This month, we're seeing very clear signals from the Governor that a pause may be on the table, perhaps as soon as April, saying he's going into the next meeting with an open mind. And a large part of this shift in language comes back to the updates we've had around the Australian consumer. In particular, the December quarter national accounts would have been quite alarming for the RBA. Not so much around the headline. GDP growth eked out a reasonable gain, slightly under expectations, but the detail around the consumer was quite alarming. Consumer spending rose just 0.3% in the quarter. That's a decline in per capita terms in the quarter. And the weakness around household incomes was particularly stark. In fact, household incomes after interest payments, tax and inflation declined 3.3% over the 2022 year. Just to put that into context, that's weaker than during COVID, weaker than during the GFC, weaker than we saw at the worst point during the early 90s recession. We have to go back to the early 80s to see a household sector coming under this much pressure. The only reason spending rose in the quarter is because households saved less of the income that was coming through. But that picture points to real constraints going forward. Households in aggregate are only saving 4.5% of their income at the moment. That compares to up around 20% during COVID. So to save less going forward, they're actually going to have to start to draw down on their reserves, the 300 billion that was accumulated during the COVID period. If we look at the other components of incomes, it's looking pretty bleak. We know that wages growth in real terms is going to be about flat at best this year. We are expecting the employment gains to really taper back to about flat over the course of this year as well. Meanwhile, we've still got interest rate rises rolling through on the cost side. We've still got inflation coming through on that side of things. In fact, the only way we're going to get spending growth this year is if households start to drain that rainy day fund. And that really is a difficult question for households at this point, given the uncertainty around the economy. Our more timely data from our Westpac card tracker suggests this weak spending picture in the fourth quarter has carried out into the first quarter of this year, but going forward it's looking like a very constrained outlook. In fact, you'd have to say, going by the Australian consumer alone, there's a very strong case for a pause already for the RBA's tightening cycle. Of course, the RBA is more concerned about the inflation outlook and ensuring we get all the way back from 8% to 2 to 3%. And on that front, they're particularly concerned about domestically about our labour market, which remains extremely tight. So for the RBA Governor, it's still a toss-up between what we're seeing around the consumer and what's happening around inflation and labour markets. But that's exactly why we've seen this shift in tone from the Governor. It's a much more open question now about rate moves month to month. Well, I think clearly we're going to see more of this very weak spending growth that we saw for the fourth quarter. We think for 2023 as a whole, consumer spending will rise just 0.7%, so barely double that fourth quarter rise. So there's more pressure to come through. And where there's real risks is that with interest rates continuing to move higher, we start to run the risk of pockets of severe financial distress emerging. This is already a very severe stress test for the mortgage belt. Most lending decisions are based on a buffer of 3 percentage points, and we've already gone well beyond that in terms of the interest rate increases. Now, for most households, they are carrying this rainy day reserve that will help them through this stress test. But within the household sector as a whole, there will be some households that don't have that capacity to draw on a reserve and will start to run into problems. The RBA has already run scenarios that suggest as much as 15% of variable rate borrowers will become cash negative as this interest rate rise flows through, and that's clearly where we're at risk of seeing real problems emerge. The other area I think is around recent first home buyers. During the pandemic, we had about 280,000 new buyers, first home buyers coming through, taking advantage of those very low rates. Those historically are the segments that are most vulnerable to interest rate increases, and that's where we again could see financial distress emerge. And there are other sectors that we need to be very aware of. About over 50% of that buffer that it got accumulated during the pandemic is in the top 2 income quintiles. So there's very little in the lower income groups. Some of those groups will be mortgage free. They'll be retirees or they'll be renters, but they're also facing significant cost of living pressures and constrained incomes. And so stress will clearly emerge in these other parts of the household sector. All of these things can contribute to a more abrupt slowdown in spending as people have to make emergency budget measures in response to these pressures.